As part of the board's assessment of the future path of inflation, we are paying close attention to trends in household spending, with the recent data showing a clear moderation. In the December quarter, household consumption increased by just 0.3%, which in per capita terms represents a small decline. As is evident in the graph here, the bounce back in spending following the pandemic has now largely run its course. More fundamentally, the combination of rising cost of living pressures, higher interest rates and declining housing prices is weighing on household consumption. The household saving rate has declined from the very high rates of recent years, as you can see, and it's now slightly below the pre-pandemic average. We're expecting a further decline in the household saving rate due to the ongoing pressures on household finances. But within the overall consumption figures, there are divergent patterns, which you can see here. Per capita spending on goods has softened recently after surging during the pandemic. In contrast, per capita spending on services has been strong recently following the slump during the pandemic. Spending on many services is now back in line with the pre-pandemic trend, with international travel being one exception to this. These divergent patterns are also evident in the bank's liaison, with some firms reporting that demand is still very strong, while others are reporting a noticeable slowing. I think it's also worth noting that business surveys continue to report that trading conditions are above average and capacity utilisation is high. Firms are planning to invest and to hire people. Looking forward, we expect a period of subdued consumption growth, especially in per capita terms. This slower growth in consumption will help establish a better balance between supply and demand in the economy and support the return of inflation to target. There are a range of offsetting factors bearing on this outlook. On the positive side, households' wage and salary income increased by more than 10% last year. People have been finding jobs and they've been finding the hours they want to work. And there's a large stock of additional savings that were accumulated over the pandemic period, so they're positives. On the other side, though, interest payments are increasing quickly at a time when inflation is high. This increase in mortgage payments is evident in this next graph. Based on the interest rate increases that have already occurred, including yesterday's, total required mortgage payments are expected to reach 9.5% of household disposable income later this year. As you can see, that will be a record high. Housing prices have also been declining, although it's difficult to determine the effect of this on consumption, given we'd earlier had a big run-up in prices. And the pool of additional savings that I spoke about a minute ago is spread quite unevenly across the community. We're unsure about how those additional savings will be run down. Given this wide range of factors influencing consumption, the board is closely monitoring the spending data at each of its monthly meetings.